welcome. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The broader markets are actually coming in the middle of a kind of profit-taking bout, if you will. Benchmarks will not actually tell you the big story. They're down less than 1%, but broader markets, even large caps, if you see the way the tilt is towards ITC, HULs, Britannias of the world, Nestle's of the world, it appears that the market is positioning itself into a bit of a safety mode. And in fact, we will discuss that forward with Vinay Paharia also joining us of Union Mutual Fund, the CIO there. Vinay, good afternoon. Thanks for your time. What is your sense right now after this big rally and the earnings, the quality of earnings which have been pouring in? Does it appear that a large part of good news, which is earnings recovery, all of that is now getting into the price?
Yeah, hi, Jay. Thanks for inviting me to the show. So I think there are both good news as well as bad news. The good news is that the macroeconomic picture is looking great. Economy is clearly bouncing back from the COVID blues, especially from the second wave of COVID. Clearly, the vaccinations have picked up pace. Offices are reopening, businesses are getting back to feet, and that's clearly getting into the expectations of earnings for companies. But coming to the bad news, the markets already seem to be discounting a lot of that, and in fact, much more than that. And we think that clearly the markets are running ahead of the fundamentals. They are trading at a valuation which are higher than fair value. And clearly, we have borrowed some of the returns from the future, which means that the future returns from equities, at least in the medium term, are bound to be a little lower than what we have experienced.
That's a very nice way of putting it, Vinay. I must say, I really appreciate your distinct style of looking at the market. We have indeed borrowed a little more than justified returns from future into present. But money managers and practitioners of investing, such as yours, job is to look for those nook and corners where risk reward is still attractive, where structural stories are intact, and there is perhaps a scope to juice out a little more alpha. Uh, what have you been researching lately? What have you been reading lately in that quest of additional alpha?
Sure. So, as you rightly said, there are always certain pockets which could have a superior potential than the general market, and yeah, we are also trying to focus on some of them. For example, we find some of the reopening plays like the aviation business could be potentially interesting to look at from a near to medium term perspective. We think that infra plays like the cement sector could be interesting. Also, sectors like telecom, IT, they continue to remain attractive. So I think these are the areas which we are focusing on and are being overweight on.
Vinay, let's construct, your framework a little more. Your broader market fund or your mid-cap tilted fund, what kind of earnings growth from these levels are you foreseeing in your portfolio uh, for next 2 years or 2 to 3 years? Do you see clear visibility of 20%, around 20% kind of earnings in your broader market, or even 15% kind of CAGR earnings next 2 3 years in your large cap fund?
See, Ajay, I think one of the big issues which most of the media seems to be grappling with is, they look at Nifty earnings or the Sensex earnings, and they try to form an opinion about the earnings growth per se for corporate India. We have recently released a research note which highlights that there is a fallacy in looking at it. What clearly drives the underlying earnings on a like for like basis is the overall nominal GDP growth. And clearly that GDP growth is coming back on track. Of course, the listed corporate India is running slightly ahead of that, which means listed companies are going to see slightly better fair value growth than the nominal GDP growth. But it cannot be completely be disjoint or completely be away from the nominal GDP growth. So yes, we are expecting slightly better than the nominal GDP growth in most of our large cap businesses. Of course, the mid cap and the small cap businesses are chosen such that they are experiencing superior growth prospects in their industries, in their businesses, because they might be disruptors, they might be gaining market share, so on and so forth. But once again, I would just say that the anchor for all the growth is the overall economic growth, and especially the nominal GDP growth. So yeah, we are expecting some reasonably good growth, especially because we are seeing the economy bouncing back from the COVID blues.
Right. Vinay, so if economy is bound to do well, what is your stand on capex? Because we are getting stray voices of industry from various places that people are announcing greenfield, brownfield capex. But on a more wider observation, because you track way more companies than perhaps we do you see capex cycle meaningfully pick up, if not already happening? And do you see it more durable beyond the 24, 36 months or for that kind of a horizon?
Sure. So, Ajay, clearly we are expecting a reasonably healthy pickup in capex in the next 3 to 5 years period, driven by superior capacity utilization, which has happened in the last 3 to 4 years, and also expectation of superior capacity utilization in the next 1 to 2 years. So clearly, companies have started planning for future capex, and we see strong capex coming back. However, very important point to note is that this capex is going to be very different than what we have been used to. So what we are going to see is far more levels of capex being spent on digital factories, far more capex being spent on technology than just on plain vanilla plant and machinery, which we have been accustomed to. So yeah, capex is coming, but it's going to be spread out over a different variety of capital goods industries.
And Vinay, I mean, you just remind me in the last 2, 3 days, the company which have been coming on my very show and talking about the same is Honeywell Automation, Hitachi, ABB, and the likes. So I'm clearly understanding where you're coming from when you say that traditional brick and mortar and large capex will not be perhaps happening, but more focused automation, digital, that kind of capex is happening in Indian factories. Where do you stand, Vinay, on the export theme? The numbers, the data seem to be suggesting category after category, good boost coming in as far as exports are concerned. How are you taking that in your portfolios, be it large cap or mid cap
Sure.
or multi cap portfolios?
So Ajay, that is also one of the themes which is part of the structural growth themes which we are looking at. There are a lot of companies in the chemical space which are unique, which are world leading, and post in this COVID period, they have already started seeing the benefits of this China plus one strategy of adopted by international peers. So their customers, I mean. So clearly there is a shift in terms of supply chains, and there are a lot of such companies in India which are getting benefits, predominantly in chemicals, pharmaceuticals, or in IT. For example, in IT, the digital IT is booming. So I think there are a lot of these white spaces which are going to get a big boost from exports, and clearly that is one of an area which interests us.
Right. Vinay, I'm tempted to also discuss with you that if indeed the roadmap for next 3 to 5 years appears to be in place, it's a earning-led structural growth recovery-led, kind of movement which is happening in the indices, and returns are also moving in tandem. Give or take a couple of percentage points when returns move ahead and then our stock prices move ahead. But the roadmap in that duration, does it look like we are in the middle of a cycle, a durable one, and nowhere near
Yeah,
the end?
I think if I get your question right, your question is on the economic growth cycle, or is it on the market cycle?
No, I meant economic growth cycle because after all, stock prices mirror economic growth and earnings.
Sure. So at least on the economic growth cycle, clearly we have turned the corner, and we are going to see superior growth in economy, and we are going to see better prospects for most of corporate India. Having said that, I would just caution on one aspect, which is inflation. If we are going to see significantly superior economic growth, we might see some slightly higher levels of inflation, which is what we should watch out for, because that could also result in, or at least over a medium term, some tightening of policies, which could have a debilitating impact on cost of equity, which can pull down the valuation multiples. So we need to be cognizant of some of the ill effects of growth as well, and yeah, that's what we are focusing on. But yeah, economic growth clearly seems to be back on track, and we are on a smooth sailing boat right now.
What are the risks we should also be cognizant of from tapering, from US tapering, if indeed, however gradual it might be, liquidity, global liquidity is sucked out? This time, are we better positioned, or you think we are vulnerable and we should be mindful of that?
Yeah. So one advice which I would want to give all your viewers is that uh, this is a period in market when most of the investors are a lot more greedy than fearful. So the idea is that you should invest in the markets and not speculate in the markets. Understand what we are looking at, why you are buying, why you are investing. There are hidden risks right now in the markets which do not appear on the surface. Making money seems to be quite easy, and that is the biggest risk in the market. I would say that we think that rise in inflation and interest rates are the biggest risk, not just for Indian markets, but for the global equity markets or any other risk assets. We have experienced falling interest rates for the last 40 years in US, and for India, we have seen falling real rates for quite a lot period of time. And if that changes, that could have a negative effect on equities. So make no mistake, even if there is earnings growth and if there is a rise in cost of equity, there could be a fall in valuation. So that is an important point which investors in the markets today should keep in mind.
All right, Vinay, we'll let you go on that one. Always wonderful to chat with you, and I'm sure our viewers would take that point of yours very seriously. See you again
Thank you,
soon.
Ajay.